Well, as the market hits record highs, almost 40% of the stocks in the S&P 500 are hitting their own 52-week highs. Is this a sign the rally has a solid foundation? Welcome to Trading Nation. I'm Eric Chemi. We've got Chad Morganlander with Washington Crossing Advisors and Craig Johnson from Piper Jaffray. Thanks to both of you guys for being here. So, what do you think? Craig, let's start with you. What are your thoughts on this market? Are we starting to get a little overbought, or is this more momentum to show, hey, there's a real broad base for this rally to come?
So, Eric, we continue to think that this has been a secular bull market. We believe that it was really confirmed in 2013, and the price action we've been seeing is late, with the market making all-time new highs, is a very good thing. I think we got to remind everyone that in these new secular bulls, sometimes the market can get overbought, you get ahead of yourself, but at this point in time, with our work, we've got over 80% of all the stocks in the market above their 200-day moving average. Keep in mind, it can stay there for an extended period of time. Tops tend to be big rounding price actions, bottoms tend to be Vs, and at this point in time, we still think that there's going to be another move higher in here. We're looking for 24 on the S&P 500 this year, and frankly, I think we're probably a little bit conservative, and there may be more upside left to go. But we like this market, primary trend is still up, and we'd be a buyer of a dip at this point in time.
Chad, what do you think about that? He was pretty aggressive there, 2,400 numbers. He wants to be a buyer. Do you want to be a buyer too?
So we're currently overweight secure equities at this point, and we think that there could be a couple more percent run within the market overall in the short run. Our long-term meaning 24, 36 months out, we have around a 5 to 6% total return on an annual basis that we're looking at. With that said, we think that earnings are going to be somewhat more listless in 2017 into 2018. The markets, I believe, are anticipating that that's going to grow substantially, not only on the bottom line, but also on the top line. We perhaps would be a little bit more cautious on that. And we also think that the emerging markets, which has had a huge run in regard to generating global growth, is going to potentially decelerate over the next 12 to 18 months. So we would be somewhat more cautious in the longer run. But in the short run, yeah, you could be overweight equities, but that's for the short run.
When you talk about those numbers, a couple percent here and there, 5 or 6% on an annual basis, that's not really an exciting, compelling trade if I'm looking to actually make some real capital appreciation. Wouldn't you agree that is that reward even worth the risk that people might be taking here?
Well, I mean, we do believe that, look, the markets have run 6% or so since the beginning of the year. So if you get another 2% bump over the next several months, you're into the 8%. That's based off of where our expectation for long-term forecasted returns is. Then perhaps you want to be more cautious. Now, one thing to consider here is growth, not only economic growth, but earnings growth. We're going to really need to see a lift there because valuations on the S&P 500 are overextended. We're looking at, a multiple of about 19 times to 18 times. Over a historic perspective, we're pretty high. Also, market cap to GDP in a lofty nosebleed territories. So you have to be careful about that as well. So you want to be a little bit more balanced, a little more conservative at this point.
Craig, and I'll just wrap up with you here. Where do you change your perspective? What does it take for you to finally give up and say, hey, you know what, maybe these gains aren't going to come anymore?
So let me just comment on a couple things that Chad had to say. This is a new bull market that started in our view. We see that happening with the charts. And I'd also to say that if we're going to get a tax cut this year, that still needs to get somewhat calculated into this market. And we're seeing earnings underpinning this move up in the market. The economy seems to be on the right side of getting better at this point in time. So still think there's more upside to go. Where do we change our opinion? Well, just keep in mind that historically most secular bull markets and bull markets in general have died and ended when the multiple in the market was north of 20. We're not there at this point in time. In fact, the sentiment toward this market still remains very skeptical. Sentiment is nowhere near where it was in 2000 or 2007. At this point in time, the pain trade is up and investors still need to be playing this from the long side, not the short side at this point.
Well, I'm glad we don't have to talk about politics. I know you mentioned taxes. We're going to have to leave that for a different conversation on another day. Chad, Craig, thanks to both of you for joining us here on Trading Nation.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.